Good afternoon to everyone. This is Maria Alicia Montes. I'm president of CFA Society Chile. And I would like to, first of all, thank Mr. Howard Marks and to give everyone who is connected right now welcome. I would like, first of all, to ask everyone please to silence their microphones, because if not, it will be very difficult to hold a conversation. And thanks everyone for connecting. Right now I see we have more than 100 people connected to this call. And I would like to thank Mr. Howard Marks, who is already here in this call. And we are going to hold a conversation, I hope, for the next 45 minutes. So thank you, Mr. Marks, and thanks for your time and having the good disposition to share your insights with all of us here in CFA Society Chile. There's also people from CFA Society Argentina, from CFA Society Mexico, and Uruguay also. So thanks.
Buenas tardes. Me gusta mucho estar aquí.
Yes. Well, I hope you're there in the US. You are already in this strange situation with the COVID. Everyone in Oak Tree is okay, and you do not have people suffering this disease in your company or in your family.
Thank you. We had 2 cases in the company at the very beginning of March, but none since then.
Okay, that's very good. Well, so giving this in this situation is quite different from what everyone here in the financial markets is used to see every day. So, and you have gone and seen many market cycles in your life, and as the saying says, history doesn't repeat itself, but it does rhyme. How do you see this one compares what we are living right now? What are some similarities? What are some differences to what you have seen before in the financial markets?
Well, first of all, Maria Alicia, I'd like to make the distinction between this episode and a normal cycle, because we have the normal cycles where things go well and then they go too well, and then people anticipate a continuation, and instead they're disappointed, and then things go poorly, and then too badly, and then people anticipate permanent collapse, and of course then there's an opportunity for rebirth. This is a very different thing. This is a idiosyncratic, one-time, exogenous event, and so I don't think this is the entry for this experience has not been a typical cyclical downturn where there were excesses and then they had to be corrected. However, number one, I do think that the preceding cycle in the years 17, 18, 19 took us to a high point from which we were vulnerable to an exogenous influence such as we received. And number 2, of course, I think that we will have what will feel like a cyclical recovery, but of unusual proportions. Similarities, but as you say, history does not repeat. There are, of course, reminders of the global financial crisis, except that was an experience that began inside the financial world, and this one comes from outside the financial world. That one came from foolhardy errors that financial institutions and lenders made. This one, it wasn't really the fault of errors made by financial market participants. It's very popular in the States nowadays to say that this is not the people's fault. They didn't make a mistake. They didn't cause the problem. And certainly that's true, but it was worsened by the fact that we were at a cyclically high level. So another similarity to the global financial crisis is that, the Fed and the Treasury came to the rescue at that time. It took them some months to figure out what to do and get financial support, get legislative support from the Congress. But eventually it was successful. This time they used the playbook from the global financial crisis. They did everything in a matter of weeks, in a very large scale, and apparently with great success. So similarities. And then, of course, the other difference is that that was being a cyclical experience. It took a while to recover. And here people are talking about, well, if we can just get the disease under control, we'll have a V. I don't necessarily agree, but that's what they're saying.
Why not?
Well,
why don't you agree with that?
Well, first of all, I think that it's going to take a while. The vaccine will not be here as quickly as the optimists hope. I would say people started to talk about a vaccine in March, and the indication from the professionals was that it would take a year or a year and a half. So that means March to September of next year, and I think that's right. The optimists think that we'll have a vaccine in the second half of 2020, and my guess is that it will not be fully approved, and if anything, it will go to first line responders at that time, emergency cases, and not to the general public. And of course, it'll take a good while to create millions of doses of the vaccine and get it distributed throughout the country and throughout the world and administered. So I think that that's one thing. Then another thing is that I think that the return to work will be very gradual, since we will not have a vaccine for, let's say, 9 months from now. I think that people who have a choice economically will return slowly. People who have to go to work are probably being commanded to go to work now or next week or the week after, something like that. But the people that'll be the people who deal with the public or deal with physical product. Those of us in the white collar world probably have the opportunity to work from home, and many will do so as long as possible. So I think it'll be gradual. I heard Hank Paulson, the former head of Goldman Sachs and the former Secretary of the Treasury, 2 weeks ago. He said he thinks that half the people who are out of work will return to work this year. He also thinks that a fair fraction of the jobs that have been lost permanently. And it's likely that a lot of small and medium-sized businesses, which were founded based with limited financial resources, will have trouble scraping together the capital to try again. So for all these reasons, I think that the recovery will be gradual. And my own guess is that GDP and S&P earnings, let me say first that I don't follow the stock market professionally and invest in it professionally, and I don't professionally make earnings projections. But my guess is that GDP and S&P earnings in 2021 will not necessarily be back to the 2019 level. And that may well take until 2022. So I think that, people have been talking about a V-shaped recovery, and I like to think about a check mark, down and then gradually up.
Yes. You talked about the actions made by the fiscal policy and the monetary policy that has been quite fast in during this upturn and making the financial markets stabilize after this sanitary response we've had to the COVID during this couple of months. In that sense, I would say that probably these policies might keep some companies that would have gone bankrupt otherwise, keep them in business.
Absolutely.
And in that sense, do you believe that these will, and you are an expert in credit markets, so does this in some way change your process, the value of all the what a good and skillful investment professional that puts a lot of interest in making this credit analysis go? And on the other side, do you believe that these actions might make misallocation of capital and capital going where it would not be worth in other circumstances?
Yes, those are great questions, Maria Alicia.
Hola, perdón, estoy en llamadito. I'm attending a Zoom call.
Alejandra, you have to mute your microphone. Thank you. The Fed, the goal has been to push out money to anybody who can use it. And they have to support the market, to give investors confidence, to encourage price discovery, and to make sure that capital is flowing freely to anybody who could use it. And the way, what I heard in the beginning, what I think is true, is that the Fed can provide liquidity, but it cannot provide solvency. That is to say, it can't make an unsuccessful business successful. It can give businesses money. It can enable them to refinance their loans when they come due. It can enable them to borrow more money to stay in business longer. But we have, there's an estimate that 20% of the companies in the high yield bond universe are zombie companies, which is to say their cash flow is less than their debt service requirements. So they shouldn't be able to stay in business. But as long as, and by the way, and a company where the cash flow is less than the debt service requirements should not be able to borrow more money. But as long as the Fed enables them to keep borrowing money, they can borrow money and then lose it. Borrow some more money and lose that. So zombie companies can stay in business for a long time under this regime. Obviously, number one, under capitalism, we get normally something called creative destruction. And the system is cleansed of the unsuccessful businesses and the insolvent businesses. And that's a good thing. And I wrote in one of my memos a month or so ago that, that the fear of bankruptcy is to capitalism as the fear of hell is to Catholicism. And, fear of hell tends to keep people on the right track. Fear of bankruptcy tends to encourage businesses to make prudent decisions. But if they believe that the Fed will constantly be supplying money even to insolvent companies, then bad decisions, and to use your terminology, misallocation of resources is encouraged. So, and then let me finally add that because the markets have been so encouraged, I believe that lots of debt is yielding less than it should to fairly reflect the riskiness. So I think that it is our job to be very prudent and to be very selective in who we lend money to. And, we have to separate the companies that are being kept alive simply by the Fed from the companies that have valid businesses. But I think we'll be attentive to that and able.
Yeah, I would say one of the big challenges is, even though the business might still make sense, once you have, if companies during this period still have to pay for their fixed costs, even if they're not getting any revenue,
right?
Of course, getting out of this situation, you will have not only a business that will be very slow at first, but a mountain load of debt that you will have to face at some time. So even though if the interest rates are kept low, the servicing of the principal of those debts will cripple the businesses getting out of this.
Well, you're exactly right, and clearly you don't by consistently lending money, you don't necessarily do a business a favor, because some of them will pile up debts that they cannot repay. The other thing to bear in mind, and you're going in that direction. All of your questions anticipate my thoughts. That if you take a business like what we're doing in this country, for example, is we're letting restaurants reopen, and they can fill 1 out of every 4 tables. Well, I'm not sure that a restaurant which is at 25% of capacity is more profitable than a restaurant which is closed.
Yes.
So these are among the reasons why I said that I think the recovery will be difficult.
Okay. I have another question in another sense. Let's get out of pandemics.
Good.
And you've written about market cycles and how investors get very greedy, and then they get very scared, and you get opportunities either to sell when they are greedy and either to buy when they're very scared and risk averse.
Right.
And that's due mostly because we are people and we have fears. But during these last years and decades, in investments, we've started using quant models and systematic strategies that are supposedly unbiased with those mechanisms that we as people do have.
Yes.
Do you believe that this that there's a structural change in the cyclicality of the markets, or are these kind of models and strategies, do they exacerbate these cycles and fears when they come? Because we've seen that when markets get scared, we see sell-offs that are probably even more violent than before.
Yeah. Well, of course, no machines are better than the instructions they're given. And so, for example, my belief is that many algorithmic approaches are momentum oriented, and they tend to concentrate capital in the things that have been doing well, in the assumption that they will continue to do well. And so I think there's, I'm not smart enough to really know, but I think there's every reason to believe that these approaches that put the decision making on autopilot would tend to perpetuate trends and exacerbate trends as long as they last. So I, when you see the way the markets have been going, it's estimated, for example, that over 95% of all transactions on the New York Stock Exchange are made by machines nowadays, or at least investors who don't make value judgments. And we've had a huge increase in index and other forms of passive investing. But when money comes in to an S&P index fund, there's nobody sitting at the fund who says, you know what, the market's too high, I'm not going to put the money to work. Or who says, you know, there are 500 stocks I'm supposed to buy, but these 50 are too expensive. I'm only going to put money in the other 450. They have no choice but to continue putting money in everything in the index, for example. So, you know, if you and I agreed for that over the next 5 years, every penny that came into the stock market would go into the S&P 500, and no money would go into any of the other stocks, then it's clear that at the end of the 5 years, the S&P 500 would be very high in price relative to all the other stocks that languished. And so these passive indices concentrate the money, these passive fund approaches concentrate the money into the things that are defined as being within the target zone and deprive everything outside of money. Now, this trend has been working for a long time, and the S&P has been outperforming lots of other things, and as a result has been outperforming most active investors for a long time. And, you know, I think that will continue to be the case until the things inside the zone are so absurdly expensive relative to everything else that there is no choice but for it to correct. You know, the trend can go on for a long time before that happens.
I believe that these index funds rely on the supposition that markets are quite efficient and
Right.
that there's enough people looking at the markets to see where mispricing are.
Yes.
So whenever you get money into these funds, you have that underlying belief.
Right.
But the thing is that becomes the market, and there is not enough people or other strategies trying to see if to make the market efficient, then the market can get these crazy things.
No, you're absolutely correct. And now I know why you are the president of the CFA Society, because the passive strategies, if you think about it, are the term we use in English, they're freeloaders. They get a free ride based on the efforts of other people. The assumption is that the active investing community keeps prices fair so that the passive investing community can appropriately allocate its capital based on market values and get an efficiently priced portfolio. But what happens when the assumption no longer holds? What happens when there aren't enough people doing active investing to keep the market efficient? You know, in other words, I first came upon the concept when I was in graduate school in the 1960s. The professor explained that the market outperformed most active investors. They said, well, why don't they just put money into each of the stocks? Well, that's a valid approach as long as the stocks are being fairly valued by somebody else. But if that person goes on strike, then the assumption deteriorates.
Yeah. I would like, in that sense, let's say that we are active investors and we want to, and there is someone who's beginning their career and they want to get skillful in thinking out of the box, seeing where these opportunities might lie. What would you recommend for someone who's just starting in the investment profession to be in this uncomfortable zone, asking everything and getting ideas? Do you have anything to recommend for that?
Well, of course, I recommend my book, Lo Más Importante, the most important thing. This book was published in 2011. I think it's still valid. And it has 20 chapters. Each chapter says the most important thing is, and then it's a different thing. And you'll recall, since I'm sure you've read it, that the first chapter says the most important thing is second level thinking. If we think the same as everybody else, we'll take the same actions. If we take the same actions as everybody else, we'll have the same performance. And average performance is not defined as doing a great job. Our job is to have superior performance, a superior risk-adjusted return. That's the criterion for an investor to do a great job. So if you're going to have a superior risk-adjusted return, you have to do something different. You have to perform different from the average investor, which means you have to view things differently. You have to see things that other people don't see. So this idiosyncratic view is very important. However, it's not enough to think differently. You have to think differently and better. And because the market is in large part efficient, because the consensus of investors is often mostly right, by deviating from the consensus, you have a hard time being more correct than the consensus. So there's the challenge. To be superior, you have to be different, but you have to be right. And often it's hard to be more right by deviating. So this is the great challenge in investing. You have to have what's called a variant perception. The average investor sees, let's say, a stock and thinks it's worth X. The superior investor looks at that stock or that company and sees something different that the average investor doesn't see, and makes either a heavier bet or a lighter bet on that company, overweights or underweights that stock in his or her portfolio. And then the question is, who turns out to be right? If you take an overweight position and it turns out that you're right or more correct than the consensus, then you'll outperform. But so these things are necessary, but they're not easy. You know, I had a matrix in one of my memos, and it was a simple 2x2 matrix. If you do average behavior, different behavior, good results, bad results. So if you do average behavior and you get good results, then you have good average performance. And if you do average behavior and you get bad outcomes, you have bad average performance. Clearly, in order to have performance which is different from average, you have to behave differently. And then if you have good performance, then you get above average good performance. But if you deviate in your thinking and behavior and you get bad outcomes, then you get bad,
very poor,
bad non-typical performance. So if you think about the 4 cells of that 2x2 matrix, only one is attractive. Yeah. 2 are neutral and 1 is negative. There's only one of the 4. And that sums up the difficulty of our job. To be a superior investor, you have to see things differently from most people, but also better.
Yeah, so that's one of my favorite memos.
So thank you. So trying to bring that back to your question, I think the point is that every would-be analyst has to understand that they can't just mirror the crowd. To be an outstanding investor, you have to deviate from the crowd. Now, it's very hard to teach anybody how to A, deviate from the crowd, and B, think better. But yes, at least people have to understand the importance of doing so. Many more people can understand the importance of doing so, then it can actually do it. But our job has to start with the conviction that we must try to see things better than others.
Yeah, but in that sense, for example, we then face the challenge of being different, but usually our clients and our employers ask us to be not so different, but much superior. And sometimes the time horizon or the deviations that are allowed before we're able to deliver that performance is not enough. So how should we manage those? Because we usually can talk to our employers, but not so much to our clients, especially if they're retail clients and many very atomized clients.
Right. Well, that's a great question. I mean, in a way, we have to, as you say, we have to get from our boss, preferably from the client if he has an opinion, an indication of how idiosyncratic they'd like us to be. Would they like us to hug the benchmark and produce benchmark performance? Would they like us to deviate a little and try to be a little better? Or would they be happy if we deviated completely in the effort to be fantastically successful at the risk of falling way short? And this is expressed usually by something called tracking error. And it's interesting. Over the years, we get notes from clients. They say, your tracking error is too high. Now, if the index makes 10% a year, and if we're up 12% some years, but 8% from others, and then they may say, you're deviating too much. So what do? You move your portfolio more in the direction of being an index. You emulate the benchmark more. And then guess what? Then your performance converges with the performance of the index. I have one client who writes me a letter and says, your tracking error is too little. In other words, I think this client has a superior understanding. And this client understands that if they're paying management fees for active management, you should be making active decisions to have a portfolio which is different from the benchmark in order to try to outperform the benchmark. However, you have to also be correct. Because if your portfolio deviates from the benchmark portfolio incorrectly, then you underperform. That's not a very good formula for happy clients either. So you used a word in asking the question, which is the key word, uncomfortable. And since you read the memos, that I always quote David Swenson of Yale, who in his book said that active management requires the adoption of uncomfortably idiosyncratic positions. Why is that? Why are these positions idiosyncratic? Well, because when you behave the same as others, you're largely insulated from criticism. If everybody, when I was a kid and I came into business and IBM was considered to be the greatest company in the world, there was a saying, you can't be fired for owning IBM, because everybody owned IBM. And if it went down, everybody went down. So you were insulated from criticism. The only problem is if you emulate everybody else, then you can't outperform. So if you want to outperform, you have to deviate from the herd, and that's uncomfortable. Because if everybody else owns IBM and you say, no, too many people are too crazy about IBM, I'm not going to own it, then you expose yourself to the risk of being idiosyncratic and wrong.
Yeah.
Oh, and one other thing, and that this comes from a memo that I wrote in 2016 called Dare to Be Great Too. And Or was it 2014 maybe? But anyway, the point is that in order to be a superior investor, you have to take the risk of being different from other investors. As we've discussed, you have to have some idiosyncratic elements in your portfolio. You have to take the risk of being wrong.
Dinner is ready. Dinner is ready.
Because when you deviate from everybody else, of course, you may be wrong. But you also have to take the risk of looking wrong, because even if you make a correct decision, it's unlikely to work right away. You say IBM's too high, you don't buy IBM. Maybe you're right, but maybe it goes up for a while. And during that period when you're underweighted or you don't own it and it's rising, guess what? It's uncomfortable. So in some intellectual sense, you may be right, but you look wrong for a good while. And if your boss or your client doesn't have enough patience, then you may pay the price for being wrong or for looking wrong, even when you're right. So this is the memo Dare to Be Great 2, I think really encapsulated a lot of the reality of our business. And it's all about these considerations.
And in that sense, I also see there's also another balance in which we have to deal with, in which we have to think differently, and we have to deviate. And probably if we are different, it can look wrong for us sometimes. But on the other side, if we are going wrong, there's two possibilities. Either it's going to correct and sometime I'm going to be right, or the market might be telling me something that I'm not seeing.
Right.
So we have to balance our own confidence with what the market is telling us.
Yes.
And it's difficult to see, should I change my opinion because the market is telling me and there's a lot of wise people in the market, or is the market crazy?
Yes. Well, yeah. So the answer is you have to balance confidence and humility. You have to have the confidence of what you're doing. You have to believe in your thesis, because the worst thing in the world is you take a position, you buy a stock that most other people don't own and you think it's great, you buy it, and then it goes down. And you look wrong for having that weighting. And of course, the worst thing in the world is to reflexively sell it just because it went down. If it goes down, if it goes on sale, as long as your thesis is correct, you should want to own more. And not having confidence in your thesis and selling it the first time it declines is really the worst thing in the world. You want to own more. Of course, if you're convinced that your theory is correct and it goes down and down and down and you buy more and more and more, if you're wrong, then maybe you lose your client or your job. So again, you have to have confidence to hold and add in the decline, but not so much confidence that you don't, as you say, consider the possibility that you're wrong, consider the possibility that you have something to learn from the market. So people said, well, how do you balance the confidence with the humility? And the answer is, there's no formula for doing so. All these things eventually come down to judgment. You can't write out, in my opinion, an algorithm or a process for doing these things. If it goes down X, you sell. If it goes down Y, you don't sell, etc. It's all judgment. And the people with the superior judgment ultimately will be the superior investors. And I think it's impossible to be a superior investor without superior judgment. You have to have a process. You have to be diligent. You have to be educated as to accounting and finance and economics and maybe even psychology. And you have to have a process which you operate routinely and consistently and diligently. But process alone is not enough. You have to have judgment. A process implemented with superior judgment is the formula to be a superior investor.
Okay, thanks. One other question. As we talked about before, usually good opportunities are in downturns and when everyone is very scared or when everyone is very greedy or bullish.
Right.
So I guess behavioral finance has some importance here.
Yes.
And we as investment professionals, should we devote in our preparation a portion studying behavioral issues, or mostly fundamental and the maths and the companies, or what has been usually the traditional way of studying finances?
Well, I think it's very important to do both. And, you have to understand finance and accounting and economics. You have to be able to do the straightforward analysis and, as you say, the math and the spreadsheet. And, but it's not enough. And the traditional analytical education tells you how to succeed in a world where things work the way they should. The issue is that the kinks in human behavior create times when things don't work as they should. And only if you can understand psychology and you can understand what everybody else is doing wrong can you take advantage of those times. It's really the human factor in investing. So I think it's very important to understand both. And Oaktree's greatest successes, I think, have come in financial crises when the world got depressed and the lower prices went, the more people wanted to sell. And because we had control over our emotions and understood the error of other people's psyches, we were able to buy aggressively at the most depressed prices. So that's a good outcome if you can do it. And I think that understanding the error in other people's behavior is a great way to add to your own results. The thing is to understand that it's typical of human behavior that when things go well and stock prices rise, people like them more. They tend to buy more, and certainly not sell at high prices. And then when things go poorly and people get depressed and afraid, they tend to sell and certainly not to buy at low prices. So our job is very simple. Buy low, sell high. Human behavior, human nature causes people to buy high, sell low. So we have to be contrarian. We have to have our emotions sufficiently under control so that we can act in a contrary way. And that's an important element in being a superior investor.
We talked about being superior investor, judgment, and I would say that comes with the person, or is it something that you can develop?
Yes. That's the challenge. In basketball, there's a saying: you can't coach height. In other words, no matter how good a coach you are, you can't make your players any taller. And if you have a team of wonderful short players, you probably can't win. So in investing, the question is, can you coach insight? Can you coach judgment? Can you coach? One of the questions I get the most often is, can I learn to be a second level thinker? And can I learn?
Yeah, that's the question.
Yes, that's the question. And can I learn to be unemotional? And the answer is, I can explain to you, and you can read about the importance of being a second level thinker or the importance of being unemotional, but I can't tell you how to do it. And so those insights, those abilities have to be inside you. And you can sharpen your focus. You can learn more skills, accounting, spreadsheet, math, whatever it might be. But, you know, can I teach you, or can you learn from a book or from somebody else how to look at a company and see things that are true that nobody else sees? That's the key to outstanding success, but it's hard to imagine how it could be taught.
Yeah, because I've read most of your memos, and you say one of your abilities is to think about possible outcomes and probabilities. And I can understand everything on that. But the difficult thing is how to assign those probabilities to those different possible outcomes. First, to define which the outcomes could be, and then which is the probability, because I know things can go up or things can go down.
Yeah.
But if it's 50-50, 70-30, 30-70, that's the difficult part.
Well, that's really, you know, it really comes down to making those judgments. So let's say, for example, that you're looking at a company and next year the earnings per share could be $3, $4, or $5. And you, not you, but an analyst who's an average analyst says, well, I don't know. It could be, they're all equally likely. Could be 3, could be 4, could be 5. Each one has a 33% probability. One person looks at it and says, no, I think there's a 10% probability of 3, 20% probability of 4, 70% probability of 5. So he sees it differently from everybody else. And if he's correct, and if he can do that correctly with company after company after company on average over his career, then that person will probably have a more successful career because he sees things differently and more accurately than most people on average. How you learn to do that is difficult. And I think that you have to have superior judgment. But, you know, what you can do is first of all, you have to learn the basic skills: financial analysis, accounting, spreadsheet, etc. Number 2, you have to understand the importance of contrarian thinking and emotional control, etc. And anybody with a good IQ can learn those things. The thing that will separate the superior investor from the others is the ability to see things differently and better on average.
Yeah. I hope we have a lot of people here who are superior investors, and I would like to, we're running out of time, so I would like to thank you, Mr. Marks, again, for your time, for your candid responses to my questions, and being available for all of us.
Well, it's a real
I hope to see you back here in Chile sometime.
It's a real pleasure, Maria Alicia. I'm a great believer in the CFA program and the CFA societies. I try to speak to as many societies as possible. I got my CFA charter roughly 48 years ago and number roughly 3,000. Now I think there are 150,000. So I may not be in the top 2% in terms of ability, but I am in the earliest 2%. And it's a great pleasure to have been visiting with you and with your members. And I look forward to a day when we can visit in Santiago.
Okay, thank you very, very much. I appreciate your time again. Thank to everyone who has been connected to this call. I hope you have enjoyed this conversation. Thanks again.
Okay.
Goodbye.
Bye-bye. See you soon. Hasta luego.